to the Inspire Wealth podcast with Prof, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Mallory Meehan, aka Prof M, and today I have a solo cast. You got me. And one of the things that I wanted to talk about today was the new tax code bill that was recently passed on the 4th of July and what it actually means for investors. What does it mean for normal people? And so I thought this would be really helpful to break down exactly what each pieces of this bill are going to mean moving forward. So with that being said, we are going to go ahead and start. So today I want to go over a couple of different components of this tax bill. So one, how the business and real estate implications are changed. So we'll talk about bonus depreciation, qualified business income deductions, Section 179, some opportunity zones. I also want to focus on families and workers because you may not have real estate or you may not have businesses now, and still some of these changes are going to impact you when you are filing your taxes moving forward. I want to get into maybe some trade-offs and some impacts. So maybe things that you were waiting to do and things that are now changing could potentially affect how you do your tax planning. Some opportunities, understanding how you can best optimize your tax savings for this year and beyond. And then finally, we'll leave you with some key takeaways and hopefully a way for you to stay involved and keep up with us here at Inspire Wealth. So the first thing that is back, which a lot of investors are really excited about, is bonus depreciation. So what is bonus depreciation? Well, this was originated from the 2017 tax overhaul, which allowed investors to deduct all of the qualifying cost of an asset. So imagine you bought a real estate asset and you had to put a lot of work into it. You had to do some renovations. The amount of money you spent on those renovations under the tax code before 2017 required you to spread out that amount over a specific period of time. That is known as depreciation. Now in 2017, that tax overhaul allowed 100% of whatever those costs were to be deducted in the year that it happened, rather than waiting over time. Now, before this new tax code became passed, we had a tier schedule. So as you can see on the left side, in 2023, that 100% went down to 80%. Last year, the depreciation allowed went down to 60%. This year, it would have been 40%, but it will be back up to 100%. So this allows investors and those that are investing in property, equipment, any sort of upgrades that you have done for your property or your business to actually receive the benefit in that tax year rather than having to wait over time for it. So really cool thing for investors, something to definitely take advantage of for sure. Now, the next thing, qualified business income. This one is a little more complex. So it has been permanently extended. And basically what this does is it allows you to withhold 20% of a qualifying income you receive through rental income, flip income, or property management income. So those of you out there who have investment properties, you get to use 20% of whatever your total income is from your rentals, flips, or property management as a complete deduction from being taxable. And so this chart here allows you to kind of ask the questions. Is your tax income? Are you going to withhold? Do you qualify? Yes or no? So this is a really great resource to come back to understand, do I get to qualify for this 20% deduction? Again, it just encourages people to invest. They're saying if you invest 20% of whatever you're making from your rentals is not going to be taxed. So I love this one too. Permanently extended, definitely a win for real estate investors. Section 179. This is a big one for those who are starting up a business. And it's very similar to the bonus depreciation in that it allows the immediate expense deduction for any of that depreciated asset. So the Section 179 allows us to immediately deduct those expenses. So if you bought a car for your business, you get to deduct the expense of the entire purchase of the car this year. You bought some new computers, you bought some software, anything like that now gets a immediate deduction in the year you bought it. So really great way to help offset some of those tax implications in the year in which you had to have that expense. Opportunity zones. So, a lot of people are unfamiliar with what opportunity zones are. And essentially, what happened was the government went around and analyzed the population density and income to identify areas of low income communities. And so, what they wanted to do was provide an incentive for investors to come and put money into these low income areas. And so, this incentive brings that private money that might not have already been brought to some of these lower income areas and helps it to revitalize the area. And so the map here is the current opportunity zone map. So you can see the yellow areas are where the federal government has identified key portions of investment opportunities that qualify for this tax benefit. So if you are an investor and you're looking at this map, you're going to want to see if the properties that maybe you're looking at qualify for this, because if they do, what happens is whatever capital gains you may have gotten on the property, they're going to stop. So you're going to have what's called a step up basis on your original gains. And if you decide to sell the property prior to 10 years, whatever your gains were, so let's say you had $100,000 of gain from the time you bought and then until the time you sell, your step up basis is only going to be 15% more than what the original gains of it was. So, again, providing a tax incentive, lowering your tax liability if you invest in these opportunity zones. Now, the whole goal is we want investors to keep their money in these areas for 10 years or more. That's really going to provide ample opportunity for these areas to expand, to grow. And so if you invest in an opportunity zone and you keep your investment in that opportunity zone for 10 years, basically any growth that you got is all tax-free. So you bought it at 100,000 and you sell it at 500,000. When you sell it, that at 500,000, if you kept it for 10 years, that is what the IRS is going to look at as your original basis. So essentially, you will not be paying anything in capital gains taxes if you invest in an opportunity zone and hold that asset for 10 years. Another big key part of this tax code is the SALT deduction cap. So, what is SALT? SALT is your state and local taxes. How much tax are you paying within your state? So, a lot of this comes down to your property taxes as well as your local taxes. So, if you have an employment tax that you pay into, or you pay state income tax, all of those combined under the former tax code limited your deduction amount to $10,000. And if you think about this, a lot of states have very high property taxes alone. New Jersey comes to mind as being number one in how high the taxes are. And so people who live in New Jersey may be paying property taxes of greater than $10,000, not to mention the other tax that they're paying for local tax or other state income tax. And so what they were missing out was the benefit of being able to deduct everything. And so under this new tax code, basically they've increased it fourfold and we're now up to $40,000. So this allows people who weren't able to capture all of that deduction previously, most of them should be much better off now. And it's going to encourage the investment in some of these higher tax states. So if you're looking at properties and you're looking at understanding where your tax liability might fall, you want to understand exactly how much property taxes are in that particular state. So again, New Jersey, New York, pretty high states. Texas has a lot of high property taxes. Pennsylvania is up there as well. So it's really good to understand how much tax liability you'll have. But now understanding that you're going to be able to offset that expense on your federal income tax deductions. For those of you who may be in the hospitality industry or who are eligible for overtime, the new tax code basically says that $25,000 in tip income is tax-free. And $12,500 in overtime, or $25,000 if you're a joint filer, so married filing jointly, is tax-free. So these are great for those who are in the service industry. So they get these deductions where they don't have to claim it. But this does phase out. So if you are in a higher income earner household, the single filers, it phases out at $150,000. Joint filers, it phases out at $300,000. So understanding what you can take advantage of. But again, a big win for the working class and those that do get tips and overtime pay. Those of you with children, we are now going to be seeing a expanded tax benefit. So previously, we only saw a tax credit of $2,000 per child. Now that tax credit is $2,200 per child. So the credit essentially lowers your taxable liability. So if you owed $2,000 in taxes and you had one child, you would offset that entire tax liability and receive $200 back. Now, if you owed, let's say, $800 in taxes and you applied your tax credit, you're going to only be allowed to receive $1,400 of it refundable. So you're going to be able to lower your tax liability with this credit, $2,200 per child, but only receive in a form of an income $1,400 per child. So again, they want to encourage people to have children. They want to help offset some of those costs. This is a way of doing that. Under this new tax code, there's also something called the Trump accounts. And this is similar to a 529 account in that you can put money away for your children. And basically $5,000 per year you can put away as tax deferred in a interest-bearing account. I believe it's going to be invested in different assets. And they're also giving a $1,000 one-time newborn credit for children born in 2025. Not sure if that's set to increase or continue, but that is at least going to be offered for this specific tax year. Now, for those of you who are looking into buying a new car or maybe giving to a charity, these deductions have also been changed. And this year, you get to deduct up to $10,000 in interest if you bought a car in 2025 that was manufactured by a U.S. Company. So if you are buying any kind of car, it has to be made here in the US to be eligible for this, but pretty much I would say all of your interest would be deducted, assuming, you're not buying a crazy expensive vehicle, but $10,000 of interest is a lot. So it would basically be all of the interest you're paying on that car is going to be a tax deduction. If you're going to be donating to a charity, you're now allowed to deduct $1,000 for single filers or $2,000 for joint filers in what's called above the line charitable write offs, which means this is going to help lower your tax bill faster than the below. And again, this is just a way to encourage giving and offer those that do give a chance to actually see that. The charitable donations had been phased as to you were only allowed to deduct so much, a percentage of what your income was. Now it's just a flat 1,000 or 2,000. So it allows those who maybe didn't meet that income threshold to still achieve some sort of a write off. For those of you who have invested in 529 accounts, they've expanded what those savings accounts can be used to cover. And now any expense associated with your child's learning while they're in kindergarten through 12th grade, and any sort of homeschooling, any exam prep, anything related to their education can be a qualifying expense. So this allows a lot more flexibility, especially if your child is expressing that they do not want to go to college per se. They want to go a different path. This allows you to use that money without being taxed on other alternatives. Now, not everything in this tax code was ideal for all. One of the things that we saw that is a reduction is the clean energy tax. So if you had invested in solar, you were investing in other renewable energy, a lot of those tax credits are going to be scaled back or even completely phased out. So really important to understand if you are thinking about getting solar, you're thinking about getting an electric vehicle, and you were going to take advantage of those taxes, you want to make sure that you understand what that's going to look like. This year may be the only year you can actually get those tax credits. If you or anyone you know are receiving Medicaid or SNAP, there is going to be additional criteria that people have to apply for and understand whether or not they're going to be eligible for these specific types of services. And so you're going to have to show that you are working part-time at least, and continue to maintain the status in order to receive the benefits. Now, the tax code in whole is expected to increase our deficit by $2.8 trillion over the next 10 years. So obviously we have some give and take. The idea is that hopefully it spurs more business growth that helps offset some of this debt on the federal deficit. For those who are in the estate planning, they actually got a huge jump. And so $15 million is a gift exemption under the current estate tax. And so this significantly increases the amount of money you can leave to your heirs without them having the obligation or liability of some hefty inheritance tax. So this one specifically really aimed more towards those high net worth individuals, those that are going to have, an estate that's worth 15 million plus. So key takeaways, what should you do? If you own real estate or are in business owner, you should definitely take advantage of the accelerated depreciation. Take advantage of the fact that whatever money you spend today, you're going to get to write it off today. So huge. Understanding if you qualify for the qualified business income and you can get that 20% reduction. Understanding if you want to invest in an opportunity zone. Again, huge tax savings advantages, but don't always pick an investment simply because of the tax benefits. It has to fit for you. It has to make sense long term. The tax benefits should just be icing on the cake. If you are a worker who is in the hospitality industry, receives tips, or works overtime, obviously you get some good tax savings there. Your state and local taxes are now extended up to $40,000. So that's really great for those of us in high property tax states. And you get to max out more charitable donations, as well as those expanded education benefits for children. If you are a high net worth or a senior, I would definitely revisit your estate planning strategies, understand the implications, understand where you should be maybe gifting money now versus leaving it in your estate, and understanding how these deductions are going to apply for your heirs. So, how should you plan? Taxes, a lot of people think are just around tax season in April. And you really need to be planning for taxes all year round. And so it's really important to have a good CPA on your side. This is going to be somebody who's going to be able to assess your tax situation and help you strategize based on what your plan is for that upcoming year. Keeping track and really good details are going to allow you to maximize those deductions and really understand where you can put those in. It's also going to be good to time out when you make major purchases. And are you going to get the bonus depreciation? Are you going to get the vehicle loan interest deduction? How much should you be contributing to charity? What is that implication going to be on your taxes? And again, estate planning, always something good. Nobody likes to talk about dying, but unfortunately, we're all going to die. And it's important to be prepared and help your heirs so that they can have an easier transition when you are gone. Now, our next episode, I will be doing another solo cast, and I will probably be doing it on a market analysis and going through one of the markets that I like currently and why people are investing there, what are some of the benefits and some of the things to look out for. I do love taxes. I love talking about taxes. Go visit our website. There is a free tax strategy checklist. You can get that at www.inspirewealthmgt.com. And like us, subscribe, tag a friend, invite somebody else to listen to this podcast. I love sharing my knowledge. If you're looking for additional information on real estate investing, business investing, I am going to be opening my online education course, Real Estate 101, and that is going to be a great place to learn how to analyze a property, underwrite a property, how to finance a property using both traditional and creative financing, and how to understand the laws and implications. So, really enjoyed this solo cast. Please leave a comment if you also got a few nuggets to take away. And with that, I am Prof. M. Out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.